Good morning and welcome to Managerial Accounting. As always, we start with a look at our calendar. So today we'll be finishing up chapter 24. We'll be starting with exercise 6 in just a minute. So you should have your See Now exercises open with exercise 6 available when we get there. Some of you I know submitted the optional draft on Tuesday. I haven't started reviewing those, but that will happen either this afternoon or tomorrow. So by the end of the day tomorrow, you should have feedback on your draft and know what changes you may want to incorporate and resubmit next week. For those of you who did not submit a draft, the full version of your project or the final version of your project should be submitted by Tuesday at the end of the day. So that's Tuesday, April 5th, our next class day. On Tuesday, also the chapter 24 problem should be submitted for grading. And next week we'll be working on chapter 25. So as always, the pre-quiz is due the day we start working on that chapter. Chapter 25 will be the final chapter for exam 3. We talked about that in class on Tuesday, so I don't need to go through that whole spiel again, but you're welcome to take that exam anytime after we finish chapter 25, whatever is most convenient for you. So if you would prefer to take that exam and then feel like you're off for the break, you are welcome to do that. Obviously, the break is this week where we have absolutely nothing due. If you prefer to wait until the week we get back, submit your chapter 25 problem on Tuesday when it's due, and then take the exam that weekend after break. That is perfectly fine as well. I think I mentioned on Tuesday about registration. So if there's anyone who is planning to, I know some of you are graduating, but those of you who are planning to return to JCC summer or fall, please make sure you're getting that appointment in with your advisor. You should be able to do that right from Starfish. And if you need assistance with that process in any way, please let me know how I can help. Advisement opens for everyone on April 18th, the day we get back from break. So I just don't want that to get lost in the shuffle. And then you come back from break and think, oh, wait, I don't want you to miss out on the prime appointments. If I'm your advisor, if you want me to serve as your advisor for this semester, I did add extra times in my Starfish calendar, afternoons, evenings, and I am glad to accommodate you. If you don't see a time there that works for you, just let me know what does work. And if I can, I will be glad to accommodate you. In general, I think it works better to have the appointments either on campus or on Zoom. So I would encourage you to schedule that way. But if that just doesn't work for you, then we can always work by email. It's just not ideal because I like you to be able to see your what's in DegreeWorks, and it's impossible to show you that if we're not live on a Zoom call or in my office. Okay. That's our calendar. Any questions? Anything else you want to talk about? Any questions from what we talked about on Tuesday or anything else before we move into the rest of the chapter? All right. Then we will just get going. So on Tuesday, we reintroduced the concept of responsibility accounting. I know I had mentioned it in earlier chapters, but now we're actually looking at what does that mean? So the idea of responsibility accounting is that we only evaluate management's performance based on those costs and expenses that come under their control. And so last class, we mentioned 3 specific types of responsibility centers, and they were a cost center, a profit center, and an investment center. So in one of our exercises on Tuesday, we looked at a cost center, and those cost centers then those cost centers do not have responsibility for revenues, only costs. We spent a couple exercises talking about the allocation of support costs, and some of those support department costs may be under the control of management. And so we did look at those exercises where we are allocating support costs and including those in our evaluation. Good morning, everyone. Including those in our evaluation of management's performance. The second type of responsibility center that we discussed on Tuesday was a profit center. And we did an exercise, maybe even two, related to profit centers, but that's where we're going to pick up today with one more example of a profit center. So for a profit center, this is an operating unit, but the management or the oversight of that unit does not have any authority or responsibility when it comes to the investment of assets in that operating unit. And so the tools that we use for evaluating a profit center are really what I think of as income statement tools, because we're only looking at revenues and expenses, not anything having to do with balance sheet related accounts, assets, and so on. After we do this one exercise, which is somewhat review of what we did last class, we will move into the third type of responsibility center, which is an investment center. And that's where everything comes together, where the management does have authority or responsibility for how assets are invested within that unit, within that operating unit of the organization. But we'll start with exercise 6, profit center responsibility reporting. Championship Sports Incorporated operates 2 divisions, the Winter Sports Division and the Summer Sports Division. The following income and expense accounts were provided from the trial balance as of December 31st, 2019, the end of the fiscal year, after all adjustments, including those for inventories, were recorded and posted. So what they're telling us is these are the final numbers. The bases to be used in allocating expenses together with other information are as follows. So you can see that the top portions here, right down to there, are already allocated by division. So they're labeled winter sports, summer sports for sales, cost of goods sold, and then the selling and administrative expense. But these 4 bottom categories are a lump sum amount that needs to be allocated between the 2 divisions. And so the information we're given in these letters A through D are going to assist us with allocating those support department costs. We are asked to prepare a divisional income statement for each of the 2 divisions. And so we can complete down as far as what's on the screen right now, we can complete all of that with the information we already have, because that information is already reported strictly for the division. So I'm going to pause the recording and ask you to complete this top part, the part that's showing down to support department allocations, and then restart the recording and we'll go through the support department allocations together. So we now have our operating income before those support department allocations. And just to remind you, the only time that we would include the support department allocations at all is for those departments that are seen to be within the authority of the division leadership or the division management to determine the usage of those support departments. And so we'll start with advertising expense, and we are told that total advertising expense was $1,090,000. But advertising expense is going to be allocated to the divisions based on usage. And it tells us already, we don't have to do any calculations, it tells us how to split that total advertising cost. So the winter division asked for or used $375,000 worth of advertising, and the summer division used $715,000. As I said, while I had the recording paused, because it does not tell us whether to use negatives or not. Typically, the software will allow us either way. And so I'm using negatives for something that needs to be subtracted, but yours should work just fine if you prefer not to use those negatives for any reason. Now we move on to the transportation expense, which is allocated to divisions at a rate of $4 per bill of lading. Now, we could have calculated that ourselves, and we went through that in the previous exercise at the end of class on Tuesday, but they've already done the calculation. That calculation would have been the total transportation expense of $192,000 divided by the total number of bills of lading that had been issued during the time period that we're analyzing here, the year ended December 31st. So they've made it a little bit easier for us. They've already done that calculation, and they're telling us to use $4 per bill of lading. So for winter sports division, $4 for 17,500 bills. If you're not familiar with that term, a bill of lading is, to simplify it, a list of the contents of a shipment. So if you are loading a truck, there's going to be a bill or a bill of lading that tells you details how much should be loaded. Usually it includes the weights so that there's a summary of the total weight if you're loading a truckload to make sure it's within the scope of that truck. And that's also an important document for the trucker to have available if they, for example, needed to enter a weigh station or something like that during the transportation. For the summer division, you guys have probably already done this while I was talking. The summer division had 30,500 bills at $4 each, or a total of $122,000. And so if you look at these numbers in combination, it should be that we are fully allocating the expense that is recorded here. If these are the only two divisions and all of the support department, as we pointed out last time, we're doing direct allocations here. We are not allocating support departments to other support departments at all. And so this is a direct allocation, the easiest of the three methods that we covered in that chapter of support department allocation and joint cost allocation. Next, we have accounts receivable. The collection expense is incurred at headquarters and allocated to divisions at a rate of $1 per invoice. Again, we could have calculated that number on our own by taking the total expense and dividing by the total number of invoices, as we did in the previous exercise. They've made it easy for us again. They must be taking pity on us, or they figure if we can do it in one exercise, we can do it in another, which I appreciate. And so again, they've given us those direct allocations. And finally, warehouse expense allocated to the divisions based on floor space. And we are given the floor space, 60,000 square feet for winter sports, 90,000 for summer sports. That's a total of 150,000 square feet. And they're actually going to have us do one calculation just for practice. So I'll put it right here. So if we take the total warehouse expense and divide by the total square footage, we get $12 per square foot. Everybody okay with that calculation? So now we can allocate the warehouse expense. I think it's interesting that they went to the trouble of telling us to round our interim calculations to 2 decimal places, but the only calculation we had to do worked out to a nice whole number. So kind of funny that they asked us to do that. $12 per square foot, and the winter sports division had 60,000 square feet of the warehouse space, total of $720,000. And then the warehouse expense for the summer sports division at 90,000 square feet.
Probably should have done it that way, because it made the bottom part easier. I just did it as ratios.
Yep,
60,000
absolutely.
feet was 40%.
Yep, so in case you can't hear what's being said in the classroom, another way of approaching this is winter sports division has 60,000 of the 150,000 square feet, and that would be 40%. So allocating 40% of the warehouse expense to the winter sports, and then the remaining 60% to summer sports. Mathematically, you're doing the same thing, but you're just thinking about it a different way. You know, the total calculations are still exactly the same, just in a kind of a different order. And so that's a perfectly valid and reasonable way of thinking about this. And actually that system, that way of looking at it might be more beneficial if you keep track of those ratios. Well, we know winter sports is 40, summer sports is 60, because next year the dollar amount is likely not to be exactly 1.8 million. And so we wouldn't have to redo the calculation. We could just say, well, 40% of whatever the total is goes to winter sports and 60% to summer sports. So, you know, there's a valid reason for doing it that way. Again, the math is the same. It's just a different spin on how you're looking at things. And total up our support department allocations. And then final steps, subtract those support department allocations from the operating income before support department allocations. Oops. Because those are expenses. So it's just like, yeah. So those are expenses that aren't directly incurred by the winter sports division, but they're for those supporting kind of corporate level processes that are happening, that they need to bear some of that cost. Okay, so any question about those divisional income statements before we go to the provides supporting calculations? Again, now I'm unclear why they're asking us to do this now when they already provided those data for us, but I guess it's having us show where those numbers came from. But this one was simply based on the total amount that each division requested for advertising. And we're just going to go through, and I'm going to pause the recording because I don't think we need to do this on the recording, but what you're doing is just showing the calculations that we did up above. Now we're just documenting them. Probably would have made more sense to do this part and then plug the totals in, but that's not the way they provided it, and I just wasn't thinking about that. So I'm going to pause the recording and let you complete the rest of the exercise. Check your work. If you have questions when we restart, of course, you can ask those questions. Okay, so we've now completed the information. Again, it probably would have made sense to do this part before we did the income statement at the top. I'm unsure why they ordered it like this. There was a question asked in the classroom about, do you need to do this? And my answer was, it's good to have your process documented, number one. So having a written record of how we did the allocations, advertising expense based on usage, transportation expense based on number of bills of lading, and so on. That's good to have documented so that next year you remember how you did it, or if someone else is doing that function next year, they can see how you did it. It also might be information that's useful for the auditors to see. They may request it. And so when you're preparing for an audit, you're typically trying to anticipate the types of questions, the types of information that they might want to see, and have it already prepared and available to be presented to the auditors when they ask. So, any other questions before we move on? Okay. So our next exercise is going to be, let me clear my screen here. Our next exercise is going to be about investment centers. And so we need to spend a moment talking about investment centers. So I really already explained what the difference is between an investment center and the other two responsibility centers that we've already discussed, a cost center and a profit center. As you can see here on the screen, the investment center, the main difference, is that the manager of that investment center has responsibility for the assets that are invested, has say in how those assets are invested. So we're talking about a high level decision-making. And so it might be a plant or a whole operating unit division of a large company that would have separate investment centers. So we can still evaluate management of that investment center using the same tools that we've already been looking at, the concept of the income statement and support department costs included in that. But now we can bring in, how does that income relate to the assets of that company or of that division? And so you can see here on the bottom of this screen, two different tools that we will now have at our disposal, be able to use to evaluate management's performance for an investment center. And we'll see the formulas for both of these in a moment. Our first exercise, our next exercise, exercise 7, will be return on investment, or ROI. So we'll have the formula for ROI here in just a moment. And then our next exercise after that, exercise 8, will be residual income, or RI, and we'll get to the formula for that. And they'll have you make a note of these formulas now so that we don't have to keep jumping back and forth between the PowerPoint and our exercises. And so, as I said, we can still use the divisional or the unit's income statement to evaluate performance, but we have new tools to make a determination or a judgment about how well they are using the assets of the company. So the formula there for return on investment, or ROI, is at the bottom, operating income divided by invested assets. But we can break that down into two parts. I'm going to give you a second to make a note of that. The general formula, operating income divided by invested assets. But I keep going, hang on one second here, let me get to. So as we look at that general formula, operating income divided by assets invested or invested assets, we can break that into two pieces, and that kind of broken down version is referred to as the DuPont formula, as they developed it as a way of analyzing their investment centers. So the DuPont formula includes, rather than just operating income divided by assets invested, it breaks that into two pieces that we then multiply together. So we can leverage either one of these two or both to increase our ROI. So the DuPont formula is profit margin times investment turnover. And let me just show you what that looks like. So rather than just looking at operating income divided by invested assets, we say, well, what makes that up? What two pieces might go together? And if you think about this from strictly from a math standpoint, we have operating income divided by sales, that's profit margin, comes from the income statement, right? Bottom line of the income statement divided by the top line, basically. How much of each dollar in sales do we get to keep as profit? And then the other piece is investment turnover, sales from the income statement, top line, divided by invested assets. And so this is a measure of how good are we at using the assets we have to generate sales? How many dollars, not dollars, but as a percentage, what portion of, or how, I think how to best phrase this, how good are we at using the assets we have to generate sales? And so if your investment turnover is, let's just say it's 4.3, just pulling a number out of the air. That would mean for every dollar in assets we have, we generate $4.30 worth of sales. From a math standpoint then, we look at this formula, sales in the numerator, sales in the denominator would simplify to 1, and we're left with that initial formula that I showed you, that I asked you to make a note of that. So regardless of whether you use the initial formula that's on the screen right now, operating income divided by invested assets, or this expanded DuPont formula, you'll get the same answer, you get the same result. But the insight that we get from using this DuPont formula lets us see if we want to increase the return on our investment, there are 2 ways we could do that. We could increase our profit margin, that is, keep more of every dollar in sales, or we could do a better job with the assets we have of producing sales, or both. So leveraging either one of these or both is going to increase our return on investment. And that's an insight that we don't get when we just look at that general formula I gave you first, operating income divided by assets invested. So hopefully while I was talking, you made a note of both of these approaches, both of these formulas, and I'm going to go ahead to get to the formula for residual income so that we don't have to come back to this PowerPoint. But any questions just about the formulas at this point? Again, in a moment, we'll get to our exercises and see how to use it. Okay. Talked about that. Okay. Okay. So the advantage of using the return on investment to analyze our company is it does help us to see how well we use the assets to produce income for the company. You can see on the slide right now, a disadvantage is that it may incentivize the wrong behavior. So we talked about this a little bit last class, that there's an incentive maybe to play it safe and to look at your individual operating unit and say, what's best for this operating unit? And that operating unit could be as small as one department within a whole manufacturing facility, or as large as the entire operating division. But we tend to get in the mindset of what looks best for us, rather than recognizing we're all on the same team, we're all should be working together for the good of the company, not just our individual responsibility unit. So we always need to be careful about that. I'm going to skip through this example. Residual income, then, our formula for exercise 8, residual income helps us to overcome some of that disadvantage. Because we are looking at more of a, instead of percentages, instead of overall ROI is expressed as a percentage, in case I didn't already say that. But residual income is expressed as dollars. And the goal of residual income, or the calculation of residual income, is to say, here's how much we are expected to earn based on the assets we have and some desired return, rated return. And here's how much we actually made. And so we're looking for an increase in absolute terms, in dollars, not just in percentages. Because for the company as a whole, we're really interested in total profitability, not some profit margin, which is a little bit more arbitrary. So, whoops. Where's my formula? All right. I don't know why I don't see. It looks like there's something missing on this slide. I'm just going to type the formula on the slide because I don't think, doesn't it feel like looking at that? There's something that just didn't show up. I'm going to just type the formula on the screen here. So please make a note of this. We will need it when we get to exercise 8 in a moment. So it's residual income, also known as RI. It is measured in dollars or whatever other monetary unit we might be using. And this is the formula. Operating income, also known as OI, minus the expected, run out of room here, ROI, expected return on investment, as we discussed in on the previous slides, times assets invested. Now, I really don't need to do this. Let me just shrink that down a little bit. I really don't need to do this because order of operations would dictate that this is the way it's calculated, but I'm just going to put the parentheses, the bracketing symbols around expected ROI times assets invested to remind you that that step needs to be done first. Okay, so please make a note of that formula, and in just a few minutes when we get to exercise 8, we'll be using that formula. But first, we want to look at exercise 7, which is a calculation of return on investment. Everybody okay? Got this formula down so I can erase it? Okay. All right, let's go back to our calculations. And so for return on investment, let's calculate using the generic formula, operating income divided by assets invested. And so for the retail division, I'll put the calculation on the screen for those of you who might want to see it. We start with our operating income and divide by the amount of assets that that division has available for use that have been invested in that division. And again, the entire assumption here is that the manager of that division has control over how those assets are invested, how those assets are used in the company. And that's what makes an investment center different than a profit center or a cost center. And we're asked to report these in percents. And so my calculation says that the retail division has an ROI of 24%. Another way of interpreting that is for every dollar invested in the division, they make 24 cents in operating income. That's what that 24% is telling you. For every dollar they have invested, they make 24 cents. Everybody okay with that? I'm going to pause the recording and allow you to do the next two calculations on your own, and then restart the recording. Okay, so as we finish that up, we can see that the commercial division came in at 22% ROI and the internet division 18%. So we can answer that final question, which division is the most profitable per dollar invested? And our answer would of course be the retail division. It has the highest ROI. Now let's look back up here at just the operating income column. If these were profit centers rather than investment centers, we wouldn't be paying any attention to the invested assets column, because again, the assumption is if you're a profit center, you don't have any control over those assets. And so we don't use them in our evaluation of your performance. So if we were looking only at this operating income column, which division would we have said was the most profitable? The commercial division, right? Different answer. We're looking at different criteria and we have a different result. The commercial division is more profitable. They have higher operating income when we don't look at the assets. When we compare it to the assets that they have invested, we can see that, yeah, but the retail division actually returns more based on the assets they have. They have a lower level of assets invested than does the commercial division. And so it kind of stands to reason that they would make less money because they have a lower amount of tools available with which to make that money. Okay, so you can see hopefully how the analysis of an investment center is different than a profit center. But as we said, one of the disadvantages is, looking at these results, the retail division is pretty happy with their 24% return. And so it may lead them to not take on a project that maybe is a little bit more risky. So they want to play it safe. They know they've got a good thing going. They're making 24% ROI and they're pretty happy about that. Maybe it affects their bonus or retention, whatever, profit sharing, I don't know. But so the retail division might look at another project and say, I think that one might only be like a 23% ROI. And if we do that one, then it's going to bring down our overall ROI. Well, would the company be happy with a project that has a 23 or a 22 or a 21%? Probably. And so it may lead the management to play it safe and to not take on any projects that would, for lack of a better way of describing it, bring down their ROI. They like where they are, and so they're now in the position of evaluating projects not based on, is this good for the company, but will it return more than 24% and pull our average up, or is it going to be less than 24% and pull our average down, and then maybe we start looking not as good as the commercial division. And so that's why as we move ahead, we're going to be looking at residual income as another tool. Now, just let me hit the check my work button. And so we're looking at the same company, Conley Industries, same three divisions, same information about their operating income and their invested assets. But we're going to put a little bit different spin on this. Now with all of these tools, I just want to remind you something that we talked about in financial accounting. We never should be looking at just one consideration. We should never be looking at just one calculation and saying, okay, now we know all we need to know. Just like as you're working on that project, I hope, I know many of you have already at least come up with a completed version of your project. As you're looking at the profitability ratios, there are like 10 different things on that list that you have to calculate. And we would never want to just say, do they have good liquidity? I don't know, what's their current ratio? No, that's not the whole picture. That's just one little piece of it. Same thing is true here. And I see that we're scrolling off the screen there, so I'm going to make this collapse that navigation piece over on the left so you can see the whole thing. But it's important for us to look at multiple different tools, looking at this from different directions and saying, okay, how do they do if we use this approach, and kind of get the whole picture, not just look at one number. That is also true here for ROI, residual income, operating income, profit margin. We don't want to look at just one tool and say, now we know. Now we've got all the information we need. And we as managers want to be very sure that we're also not incentivizing the wrong behavior by saying, for example, profit margin is the only thing we care about. Because that could lead you to leave some money on the table. Well, we're not sure that project's going to be profitable enough. It's going to pull down our profit margin, so we don't want to do that. We always want to be getting that big picture. And we always want to make sure that our managers recognize the big picture as well. It's not just about what operating income is produced or what the profit margin is or any one single tool. So let's go to our residual income. We already have the formula for that, so you should be good that way. My papers. And I want to start with what's expected of these divisions. So assume that management has established a 15% minimum acceptable return for invested assets. Now, there's no way for us to know what the right number is there. But I'm going to show you just a brief little explanation of where that number might come from. Minimum acceptable return for invested assets. I'm just going to show you and I know you're thinking, okay, we learned this literally in chapter 1. What's she doing writing this on the screen? Just stick with me. I hope. Whoops. Come on, I just want to move it. It will all become clear. So we all recognize this as the fundamental accounting equation. So what does this have to do with analyzing a company's return on investment, ROI, or residual income? Why are we talking about this? Well, every company has a unique capital structure. And when we talk about the capital structure, we're looking at what I think of as the credit side of the balance sheet, the liabilities and equity. But I want to break that down a little bit further. I'm going to abbreviate to make sure I have enough room here. In chapter 4, we started separating liabilities into 2 categories: current liabilities and long-term liabilities. And all the way back in chapter 1, we had broken our equity into 2 pieces, which is I will write these out a little bit to remind you, contributed capital and retained earnings. Okay, so I can take that fundamental accounting equation that we have known for months and months. It should be second nature to you at this point. And I've expanded a little bit to classify the liabilities based on when they're due, and also separating the equity into its components. The original investments from our shareholders, that is contributed capital, and the retained earnings, that's the amount that the company has made and did not pay out as dividends in its simplest version. And so when we talk about the capital structure of the company, we're looking at this part of the equation. Long-term liabilities, that's the borrowing. As we learned in chapter 11 in financial accounting, that mainly for companies consists of corporate bonds. There are, of course, other long-term liabilities in there, but the principal part of their capital structure is the borrowing, the bonds. And then we have the contributed capital and retained earnings. And as I said, that makes up the capital structure of the company. So when a company's thinking about their desired rate of return, they're looking at this capital structure and saying, how much do we need to fund this capital structure? It's beyond the scope of this class to get into where those numbers come from. The easiest one to recognize, though, is the long-term liabilities. And the cost of borrowing is very simple, well, kind of simple, in that it is the interest rate that we are paying, the cost of borrowing. The cost of funding the contributed capital, our stockholders' investments, and retained earnings, the earnings of the company, is a little bit more complicated and not something we're going to be talking about in here. But the simple version is, it's the expected return that our stockholders have for us. They gave us their investment, and what do they expect in return? So when we're talking about invested assets for our calculation of residual income, and we are told, the screen, we are told here that the company has decided that 15% is the right number. That's going to be based on this type of analysis. What do we expect you to, we, top management, we are giving you, the manager of the investment center, some money. And you have the right, the responsibility of investing that money in your division to make it profitable. And what do we expect to get back? And part of it, a good part of it, is related to this. Well, how much do we need to get back to pay our bills, pay the bonds off, to earn a decent return for our stockholders? So for our purposes in this class, we're never going to have to figure out what is the right percentage to use, what is the correct minimum acceptable return. That is a management decision, and it's going to be very different over time and within different companies and different industries. But this is the nutshell of where that number originates. So let's look at the retail division. The retail division has $40 million worth of assets invested that the management of that division gets to decide how best to use those assets. But the company, Conley Industries, that the top executives have said, but we expect you to return at least 15% on those assets. So if our, let me tool back up here, I'm putting this down at the bottom. If our division has $40 million at our disposal and we're expected to return 15%, then what management is really telling us is we want to see $6 million of operating income from your division. We've given you $40 million worth of assets. You get to decide how to deploy them. And we're just going to tell you $6 million is what we expect back at a minimum. How much did they actually return? 9.6 million. So the excess, the residual, remember residual means what's left over, the residual income over and above the minimum we're expected to produce is, number of zeros in there, $3,600,000. I don't know how many of you are churchgoers, and I don't need to know that, but I just want to say this whole exercise that we're doing here kind of reminds me of a reading that comes up this time of year. We just had this reading in church about the landowner who's going away for a long time, and he takes three of his, what I'm going to call managers, we can think of them as these three divisions, and says, here's a few, they use the term talents as, or I'm just going to use dollars. Here's a few dollars. While I'm gone, do something with these dollars. And the one guy goes out and is really aggressive with those dollars, and he turns a big profit for them, for the owner, for the landlord, the owner. And the second guy is a little bit more conservative, but he still makes some money for the landowner. And the third guy takes his talents or dollars and buries them because he knows that the owner is a hard taskmaster, and so he's afraid of losing that money. And so he buries them, and when the landowner returns, he says, you gave me $1, here's your $1 back. Or you gave me $10, here's your $10 back. It's kind of what we're doing in this exercise. And so I like that analogy of what are you doing with the assets that we give you? Are you sitting on them and returning, in this example, returning just the $6 million that we said, here's what we expect from you? Or are you actually doing something to benefit, in this case, Conley Industries, or in the Bible story, benefiting the landlord? So it's kind of the same situation. Everybody okay with what we just calculated though? Even if you don't get my analogy, it's okay. And we could put the negative there again. It doesn't tell us to, but if it helps you to remember, we're comparing the difference between what we said, you must return this or else, and here's how much we actually returned. Let's do that same calculation then for the commercial division. So the commercial division, as we pointed out in the previous exercise, actually has more assets available to it. And because that division has more assets available, we expect a higher dollar amount of return. And so, here we go. The commercial division, with its higher amount of assets invested, has a higher expected return. Same percentage, 15%, but 15% of a larger number. And again, I'm going to put the negative in there just to remind us. And so, how much did they have left over after the minimum amount that was expected of them? And so you can see we get a little bit different approach here. In the previous exercise, when we looked at return on investment, we saw that the commercial division return on investment was just 22% compared to the retail division's 24%. And so when we only looked at ROI, we said the retail division is the king. But in this example, we can, at this point, we're going to do internet division in a moment. At this point, we would say, yeah, but the commercial division actually brought in more excess income than the retail division did. As a percent, it was not higher, but in terms of the dollars, that bottom line that is really the concern of the company, the commercial division did a better job with the assets they had. Go ahead and do the calculation for internet division. They have the smallest amount of assets. And their residual income is smaller than both the retail and the commercial division. They also, you'll recall, had the lowest ROI of the three divisions. And so not surprising, lowest ROI, lowest amount of assets invested, lowest residual income, not surprising. So which division has the most residual income? Obviously, that would be the commercial division. And so, again, the point of this concept of residual income is we don't want to incentivize, we don't want to encourage our managers not to take risks, to play it safe. when we might be leaving some profitable investments on the table. And so again, just one more way of looking at an investment center to evaluate their performance.
So for when we're working with the residual income, we should receive an expected ROI, right? That should be given to us.
For our class, yes, it will always be given to us what is the minimum acceptable rate of return. Yes, that will always be given. We cannot be expected to figure that out because it really is dependent on the company, the industry, the time. So what's acceptable one year, next year might not be acceptable because maybe interest rates have gone up. We're expecting that to happen here any moment. And so each year the company will evaluate what's an acceptable or expected rate of return. Any other questions before we keep going? Okay. Okay, so our next exercise is using the DuPont formula. So we already talked about DuPont formula and the looking at return on investment, teasing apart the two pieces that are really represented there, the profit margin and investment turnover. And so I'm going to pause the recording. I'll put the formulas here on the screen. And then I'm going to pause the recording and then ask you to do part A on your own. So profit margin is operating income divided by sales, and investment turnover is sales divided by assets. And then return on investment in this case, because we already have those two numbers, will be profit margin divided by investment turnover. And so those are the three formulas that you'll need to do this part A, and I'm going to pause the recording and ask you to do those on your own. So I put the calculations here on the screen. I found profit margin of 17%, investment turnover of 1.6, and then we could either use the simple formula, or because we already have those two previous calculations, we can simply multiply those together, profit margin times investment turnover, 27.2%. And so we can see, again, how the combination of profit margin and investment turnover lead to return on investment. And so we recognize, using the DuPont formula, that we could improve our ROI by improving either the profit margin, keeping more of each dollar in sales, or investment turnover, using our assets more efficiently to produce more sales, or maybe both. And that's what we're going to look at in part B. So I'm going to erase this stuff so I can scroll down and keep those formulas. So. Part B says, if expenses could be reduced without decreasing sales, what would be the impact on the profit margin, investment turnover, and return on investment? So investment turnover, before we do anything else, let me remind you, investment turnover is based on sales and assets. So does changing our expenses impact either sales or assets? No. So investment turnover, we can already say, is not going to be changed. We're not impacting the use of our assets to produce sales. But what is changing is our operating income. Our operating income, if we reduce our expenses without changing anything else, our operating income will go up by that same amount that expenses are reduced. Does everyone agree with that? Everybody's okay with that? Okay. So if we start with our original operating income and say, yeah, but reducing our expenses is a direct increase to the bottom line. Reminder, we're talking about operating income here, so we're not considering the impact on taxes. Our net income would actually not go up by quite the same amount because of the impact of taxes, because making more money would increase our taxes. And so we're strictly looking at operating income, which is pre-tax income here. And so we take that new operating income, new higher operating income, and divide by sales, which was what? Mine's blocked here. $230 million. And so calculate your new profit margin. If I did the calculation correctly, I got 18.5%. Yes. And so 18.5% times 1.6 gives us a new return on investment of 29.6%. Our profitability only went up by 1.5%, but it's leveraged by that investment turnover. And so our return on investment goes up by a total of 2.4%. So just to recap, we recognize when we use the DuPont formula that improving either profit margin or investment turnover will have a positive effect on our return on investment. I mean, ideally, we're looking at both of those. How can we be more efficient at producing sales? How can we keep more money, more of each dollar in sales? But we can see here, even improving one of them will be magnified or be an even better, as long as that investment turnover is greater than 1, will be an even higher impact on our return on investment. Questions, anybody, before we move to our final concept for this chapter? All right, I need to go back to the PowerPoint. Whoops, I need to clear my drawings. We'll go back to the PowerPoint for a little bit of discussion about transfer pricing. There's really no place for me to put this dumb thing, so it's out of the way. I apologize for that, for those of you who are in the classroom. So our last concept and our last exercise is related to transfer pricing. So I've been trying to hit on the idea of looking at the big picture. So that we're not living in our little silo, our own personal responsibility center, but we're seeing how does what we do impact the rest of the company. It's even more challenging to see when we're talking about a very large company that might have multiple different parts. And so when we talk about transfer pricing, we're talking about selling intra-company, I-N-T-R-A, intra-company. So we make widgets, let's pretend we're Division X. We make widgets and we're going to sell those widgets to Division Y, which is part of our same company. And so in this exercise, in our final exercise, we're going to be looking at 3 different ways of deciding, well, how much do we charge them? Recognizing that we're the same company, but that some of our incentives might be not at the company level, but instead at our own responsibility center, at our own division level. And so while our incentive might be to maximize our individual division profitability, the goal of the company is to maximize the company as a whole's profit. So we'll be looking at all 3 of these approaches: market price, negotiated price, and cost approach. that reminds me, I need to point something out to you. Give me just a second here. I can get out of this PowerPoint. And in Blackboard, if you go to the reference materials for this chapter, there is a piece of helpful information for you for working on the problem for this chapter. And I especially wanted to make sure I pointed this out because I've already told you it's okay if you want to go ahead and do the chapter 24 problem and take the exam anytime after today. No, sorry. No, you don't want to do that. I totally misspoke. We have to do chapter 25 first. But if you wanted to be working on the chapter 24 problem, I have kind of walked you through how to look at the transfer pricing part of that problem. So it's not the whole problem, but this will help you. So if you're working on the problem, if you get stuck on the transfer pricing part, please make sure you come and read what I've said here and try to apply what I've said here to the problem. As always, if you get stuck, if you need help, ask. But first step is to read what I have here. And if that doesn't help, then I'm glad to work with you. And that brings up another question. So I had scheduled one of the drop-in review sessions for Tuesday of this week. I did not have any takers on that, which is fine. Hopefully that means not that it was you're busy and it didn't fit in your schedule, but you really needed it, but that you didn't need help on the last chapter. I'm hopeful that that's what that is meant to mean. If you want a review session for next week, I'm going to leave it up to you to let me know, yes, I would like to attend, and maybe here are a couple times it would work for me. Because it doesn't make sense for me to continue scheduling them around my schedule when I'm not getting feedback from people about what would work for you. So if you want one next week, please just send me an email to say, yes, I would like to attend. Here are a couple times that would work for me, Tuesday afternoon and Friday morning or something like that. And I will be glad, as it fits in my schedule, to find a time that hopefully will work for the majority of people who might want to attend. And if you don't need help, that's okay too. But I just want to make sure that that's out there. People, the reason I started doing those is people think because we're not on campus, or most of us aren't on campus, people aren't using office hours at the same rate that they might have used them in the past. And so I'm just trying to get people to think about using me as a resource, in particular for this class where I know there isn't a tutor available. So, all right. Let's go back to our discussion here unless there are any questions about that. Okay, send me an email if you do want to have a review session at some point next week, and I'll be glad to put that in the calendar. And so there really are two extremes here. When we talk about those three different possible transfer prices, the extremes are, how much does it cost you to produce it? Okay, that's how much you have to sell it for. In other words, you can't take any profit at all. The other extreme is, how much could you sell it if you were selling it to someone outside the company? How much would you charge them? Because I hope it's clear that you wouldn't charge intra-company at a higher price than you can get from an outside customer. And the reality is, frequently the price is going to be somewhere between those two, that you're going to negotiate a price that represents some profit for the selling division, but also a cost savings for the purchasing division. And that's what we mean by negotiated price. We've talked about in the CVP analysis chapter, we spent quite a bit of time talking about variable and fixed costs. We recognize that fixed costs do not increase if we take on additional work within our practical capacity. And so when we talk about the cost of producing the product, we could be looking as low as just the variable cost per unit And again, in the CVP analysis chapter, when we talked about should a company take a special order product that is within their practical capacity, should they allow a special price that's maybe below the full cost per unit, but it does more than cover the variable cost. And that's what we're seeing in this slide. Okay. So I think we'll just go to our exercise and work through, now that we've described each of these three approaches, we'll go to the final exercise and work through each of those three options. Decision on transfer pricing. Make that a little bigger. There we go. Materials used by the instrument division of Ziegler Incorporated are currently purchased from outside suppliers at a cost of $1,350 per unit. However, the same materials are available from the components division within the same company, within Ziegler Incorporated. The components division has unused capacity, and I reminded you about that term practical capacity a couple times in the last minute here. Practical capacity is how much they can do in reality, and excess or unused capacity is the difference between what they're currently producing and what they could produce without taking on any additional fixed costs. So they have the ability in the components division to produce this material that the instrument division needs. And they can produce the materials needed at a variable cost of $900 per unit. So I said we'd talk about the three different versions of transfer pricing. So what are the extremes here? It could be that the components division charges the instrument division $1,350, exactly what they'd be paying from someone else, but we keep the business in-house. That's still a win for this company, for Ziegler, the big picture. No change at all for the instrument division because they'd be paying exactly the same price. It would be an increase in the profit for the components division because they'd be making an extra $450 for each one of these units that in contribution margin that they would not otherwise be making because it's excess capacity. They don't have demand for orders outside the company. If they charged just the $900, it would save the company, Ziegler Incorporated, it would save the company $450 per unit over what they're currently paying. And so the profitability of Ziegler would increase by $450. The components division, though, wouldn't make any additional contribution margin because they're only covering their variable cost. The $450 in additional contribution margin would go to the instrument division. And the third option then, that negotiated price would be, we charge them somewhere in between those two numbers. And if we do that, then that extra $450 per unit in profit or contribution margin would be shared between the two divisions. And so that seems like a very reasonable approach to negotiate a price which may or may not be, probably more often than not, it's not going to be, let's split the difference. It's $450, so let's give each division $225 of that, and the transfer price would be $1,125. That sounds very reasonable, fair, and equitable. That's probably not the way it's normally done. Again, for our purposes, we cannot determine what that price should be. We can determine the range. In this case, it's going to be somewhere between $900 and $1,350 per unit. Anywhere in there, the company is better off as a whole, Ziegler Incorporated. But then we have to decide who gets, which division gets the benefit. And that's where the considerations of how are we incentivizing this between the two divisions? What tools are we using to analyze if these are investment centers? What tools are we using to analyze that? And if they're profit centers, we're only looking at that income piece of it, not the assets part of it. Before we get into the actual calculations for this exercise, does what I've just said make sense to you? Do you understand why the limits on the terms of trade are between $900 and $1,350? Obviously, we're not going to make the instrument division pay more than what they're already paying to an outside supplier. That wouldn't make any sense at all. And we're not going to make the components division sell them for less than they have in them. That is the variable cost. Everybody okay with that? So as I said, we can't decide what the appropriate price is. And for this exercise, we're told that we're going to use a price of $1,000 per unit. And we're going to sell them 75,000 units with no impact on the components division current sales. Remember, they had that excess capacity. We're just going to produce. Our fixed costs are going to remain the same. And we're just going to sell 75,000 more units, produce and sell 75,000 more units. So the first question we're asked is, what impact would this have on the company as a whole, on Ziegler Incorporated's operating income? So they were paying $1,350 per unit when they were buying them from an outside supplier. They're now paying only $1,000. That's a $350 savings for the company as a whole for the 75,000 units. $350 savings times 75,000 units is a big chunk of change. What did I just, oh, whoops. Sorry, hang on. I put that in the wrong spot. Let me just redo that math. If I can. Ignore that 26,250 for the moment. We'll get back to that calculation in just a moment. If I could, I could have just moved it down to part B, because that's the increase for the instrument division. For the company as a whole, I was not doing this, not thinking about it completely. For the company as a whole, it's only costing them $900 to produce the unit. There we go. And I should have put that calculation for the instrument division. Who's making them? No, for the components division. They're selling them for $1,000. It costs them $900 to produce them. And so they get an extra $100 for each of those 75,000 units that they were not producing before. For the instrument division, this is where I meant to put, they were paying $1,350. They're now paying $1,000. Got my numbers confused. So they're paying $1,000 for the instrument division. Now they're saving $350. The cost was only $900, and I got confused about which numbers, so this calculation should have been here. That's the savings for the instrument division. The extra income for the components division would be the extra $100. Oops. And then the total increase in income for the company would be the combination of those two. So since I misspoke as I did part A, the company as a whole went from paying $1,350 to buy them from an outside supplier to the cost of $900. And I had said that it was costing them $1,000, but that's not what we are told right here. The cost is $900. For the instrument division, they get to save $350 by only paying $1,000 for them now. And for the components division, they make an extra $100 over their variable cost in contribution margin. Remember that term from the CVP chapter, for each of the 75,000 new units that they're selling without impacting their fixed costs or their existing sales. And so hopefully after this conversation, you can see the intricacies of selling inside the company, some of the considerations, who gets to benefit from that. I can't tell you why for Ziegler Company in this example, why they decided to give more of the benefit to the instrument division and less to the component division. If you're the manager of the component division, you're happy in that your operating income goes up. Remember, we just spent all that time talking about ROI versus residual income. Their ROI as a percentage probably just went down. But their residual income went up because they're making an extra $7.5 million. They're not making as much, assuming, I'm making the assumption that if they were selling them to an outside entity, they could also sell them for this $1,350. I don't know that to be true, but I'm assuming that's the market price. And so we can see here the benefit of making this intra-company transfer. For the company as a whole, it's dramatic. How we split that between the involved parties is an internal, maybe even a political decision inside the company, who gets most of the benefit. And I don't know how that was determined. But if I was the component division manager, I'd be a little bit less than happy about that probably, especially if my pay was based on, it might be a bonus or something like that, was based on our ROI. And yet this price is really probably imposed on the components division. They probably are not allowed to set that transfer price. It is likely a corporate decision. Here's how we do transfer pricing if you're going to sell to other divisions within the same company. All right, so that's the end of the chapter. I should get my green check marks in there. That's the end of the chapter. Is there anything you want to ask about, talk about? Everybody okay with your projects at this point? Should be finishing those up soon, if not already. Okay, so please let me know if you do want to schedule a review session for next week. Let me know what time would work for you, and I will be glad to accommodate that if I can. Good luck on your projects. If questions come up, I've been fielding questions by email over the last few days from people. I'm always happy to help. If you're just not sure where a number's coming from, or can't find something, just let me know, and I'm happy to help. All right. Enjoy the weekend. See you Tuesday.